Good morning, everyone, and thank you for joining us. For those of you who don't know me, my name is John Giordano. I'm a partner here at Citron Cooperman, based out of our Long Island office, where I serve as co-leader of our firm's manufacturing and distribution practice group. With me today to assist with fielding some Q&A questions is my partner and co-practice leader, Mark Henry from our Boston Metro office.
Good morning.
For those of you unfamiliar with Citron Cooperman, we are a top 25 full-service accounting, tax, and advisory firm with offices along both coasts, East and West. With manufacturing distribution being such a significant practice area here at the firm, we have made it a point to conduct our annual pulse survey, dating back to 2020, when the world took a very drastic turn none of us were prepared for. This year's survey is appropriately titled The Rewards of Agility, as many of the companies that showed success during 2021 consider their ability to adapt and change as a key to their success. In today's webinar, we plan to discuss not only the results of our survey, but some of the more burning questions about the state of our economy and where we might be headed. We're fortunate enough again to have Anirban Basu with us for the third consecutive year. Each year, he has kept our audience fully engaged with his charismatic style of talking about the exciting topic of economics. For those of you who know or may not have been with us in prior years or need a reintroduction, Anirban is a chairman and CEO of Sage Policy Group, an economic and policy consulting firm headquartered in Baltimore, Maryland. His firm provides strategic and analytical services to M&D companies, energy suppliers, law firms, medical systems, government agencies, real estate developers, among several others. Dr. Basu has provided his economist experience or an expertise to a variety of companies over the years while serving as an economic chair, as well as members of various boards. Dr. Basu earned his Bachelor of Science in Foreign Service at Georgetown University. He earned his Master's in Public Policy from Harvard University's JFK School of Government and his Master's in Economics from the University of Maryland, College Park. His Juris Doctorate was earned at the University of Maryland School of Law. Now, before I turn over to Anirban, please remember to submit any questions you may have through our Q&A feature in the Zoom. We will do our best to address them during our webinar. If we aren't able to get to them during the presentation itself, my partner Mark will be hosting a full Q&A at the end. Now, without further ado, thank you again for joining, and please welcome Mr. Anirban Basu, Dr. Anirban Basu.
Righto, thank you so much, and let me share my screen with you all as we talk about the economy and, of course, this pulse survey. In fact, what I'm going to do for you today is I'm going to try to interweave the pulse survey results with the performance of the macroeconomy to try to talk about the microeconomics embodied within the survey and the macroeconomics that we are all contending with. And so thank you very much to Citron Cooperman for conducting the survey, of course, making the results available to our staff in Baltimore, and for us to be able to analyze those data and then present our findings to you. As had been noted, please use the features of this platform to ask questions. I will leave some time at the end for questions and answers. Actually, there's a lot of waterfront to cover, but I still intend to leave at least 10 minutes or so for Q&A. So let's get into an economist's perspective on where we are in the economic cycle and what the survey tells us. And I think what you're going to find is that this year's survey is especially revealing. But again, before I get to the survey, let me talk about where we are in terms of the macroeconomic situation. And I think that it's important to be honest. And I'll be honest, I have not been so much surprised by the fact that we've been in an inflationary episode. I think what I've been surprised about, and perhaps you have also been surprised by this, is how durable it has proven. And that along certain dimensions, if anything, inflation is getting worse. So as we wake up this morning, natural gas is trading well above $9 per million BTU. Oil prices are around $121 a barrel in North America. And, we economists like to say things like the cure for high prices is high prices. The notion, of course, of high prices is that it results in demand destruction, A, and B, it serves as motivation to expand production. And both of those things would tend to drive those high prices down. And for the most part, we just really haven't observed that yet. There is some evidence that perhaps inflation has peaked, but it's very weak evidence, and there's no guarantees that will stand up. And so somewhere out there might be a millennial who, at least pre-pandemic, thought, well, inflation is 2% a year. That's what it is. It's 2% a year. Why do we even measure it? It's 2%. Well, those of us who grew up, of course, during the 1970s into the early 1980s know that it need not be 2%. It certainly has not been 2%. This is your US Consumer Price Index, 12-month percent change. By the way, a lot of the data I will show you today are time series data. And so the more contemporary data will be toward the right of the slide. And what do these data indicate? Well, if you look at the black line here, that's the all items consumer price index. That indicates that over the past 12 months through April of this year, inflation running at 8.3% year over year. Well, that's above 2% millennial. The core inflation rate, the so-called core inflation rate, all items less food and energy, which is that lighter blue colored line, is running at around 6% year over year. But either way you slice it, it's a 40-year high in inflation, as you know. As I say, there are some other indications of inflation that suggest that maybe we have peaked. So for instance, back in March of 2022, 1 month earlier than this time series ends, inflation was 8.5% year over year. So now it's 8.3%. But I find that to be extraordinarily weak evidence that inflation has peaked. And in fact, since that time, as you know, again, oil prices have risen, natural gas prices have risen, and those price increases circulate through the economy in various ways. And we'll talk about that, whether in the form of impact to manufacturing costs or, of course, distribution and transportation costs. But that's where we are. And I must tell you, as I say, that this bout of inflation has come as a surprise to many folks. Again, not simply because inflation has risen to such lofty levels, but because of its durability. And I would say to you that this bout of inflation has surprised some people who ought to have known better. And I'm engaging in some Monday morning quarterbacking here, as it turns out. But I say that they should have known better because they actually influence inflationary outcomes in our society. And I speak, of course, of the folks at the Federal Reserve Bank of the United States, the folks who at their Federal Open Market Committee meetings fashion monetary policy for this country by establishing short-term rates that they control, Fed funds rate, for instance, discount rate, by shaping the size of the Federal Reserve's balance sheet, which often influences longer-term rates. Here's some statements that came out from the Federal Reserve in 2021, those FOMC meetings. So if you look toward the northwest of the slide, back in June of 2021, this is what they said. Now, it's important to note that inflation begins to really manifest itself during the early months, including the spring of 2021. And by the summer of 2021, inflation is running at a 6% pace on a year-over-year basis. So at that time, June of 2021, the statement was, quote, inflation has risen, largely reflecting transitory factors. A synonym for transitory is fleeting, very temporary. The notion at that time was, and this is a year ago, that yes, we have this inflationary issue in America, but don't you worry about it. We've got it under control. It's going to go away on its own. This is the reopening from the pandemic, some lingering global supply chain disruptions. But again, nothing to be concerned about. It's merely temporary, very temporary. By July, the statement was inflation has risen, largely reflecting transitory factors. Ladies and gentlemen, nothing has changed. We at the Federal Reserve still have this under control. We know there's inflation out there, but it's going to go away very soon. Please stop sending us your emails. Please stop making nasty TikToks about us. We've got this firmly in hand. Now, by September, the statement was inflation is elevated, largely reflecting transitory factors. So they changed the word risen to elevated. So it rose earlier in that year, 2021, and then it remained elevated. So they changed the word. But the key word here remains transitory. It's fleeting. It's temporary. And not only that, but we actually at the Federal Reserve don't have to do anything about this. This is going to go away on its own. Now, by November, the statement is, quote, inflation is elevated, largely reflecting factors that are expected to be transitory. And now for the first time, they're admitting that they're not quite so sure that it is transitory. By this point, inflation is getting built into inflation expectations. By this point, people aren't thinking inflation is going to be 2% anymore. And so they're building that into their pricing for the year to come. And by December, the statement is completely transfigured. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. The word transitory is dead, gone, and buried. But not only has the Federal Reserve at this point pivoted, in terms of its language, it's pivoted in terms of policymaking. By this point, it's pretty apparent that the Federal Reserve is going to have to tighten monetary policy to deal with these inflationary pressures. They're going to have to withdraw accommodation. So around December, the conventional wisdom among many economists was that the Federal Reserve might have to raise rates 3 times in 2022. The first economist I remember who suggested it might be 4 times is a guy named Jan Hatzius. Jan Hatzius is the chief economist at Goldman Sachs. He's at Goldman Sachs, so his house is bigger than mine, but he doesn't drive a Mustang. In any case, he was the first I remember to say, they might raise rates 4 times, meaning quarter-point equivalents. 4 quarter-point equivalents in 2022. The conventional wisdom now is that the Federal Reserve will raise rates 9 or 10 times this year in terms of quarter-point equivalents. It's already done it 3 times. So in March, it raised its short-term rates that it controls by 0.25% for the first time since 2018. Raised rates for the first time since 2018. And then on May 4th, it increased interest rate 0.5%. So that's 3 quarter-point equivalents in the books already. We'll get 2 more quarter-point equivalents this month, meaning 0.5% this month, increase in short-term rates, 0.5% next month. So now you're up to 7. I mean, these are predictions, of course, but this seems to be what the Federal Reserve is signaling in terms of their action or imminent action. And then, another quarter point probably in September, and then, we'll see what happens thereafter. But the point is, they have pivoted. Now, a separate statement came out in December of 2021, which is not that long ago, parenthetically, it's only 6 months ago, from our Federal Reserve Chairman, Jerome Powell, who says, quote, "These problems have been larger and longer lasting than anticipated." What's he saying? We've been surprised. The Treasury Secretary, Janet Yellen, who was the former Federal Reserve Chairperson, has also been indicating we were surprised. We didn't see this coming. Exacerbated by waves of the virus. Not our fault. This is Delta. This is Omicron. We're not genetic epidemiologists. We're not virologists. We're just monetary policymakers, and we messed up. As a result, overall inflation is running well above our 2% longer run goal and will likely continue to do so well into next year. Well, they actually got that part of it right. Inflation is well above 2%, isn't it? And again, I suggest to you that these folks should have known better because they actually influence inflationary outcomes. This is why we wouldn't allow a basketball player to bet on a game in which they're playing. It's because they actually influence the outcome. By the way, speaking of basketball, go Celtics. But the point is, they should have known better. And again, I'm engaging in some Monday morning quarterbacking to keep the sports analogies going. But the point is, they should have known better because they shape these outcomes, including by shaping U.S. money supply. Here, graph back to 1959. Now, you can see how profound the growth in money supply has been during the pandemic. In economics, there's an equation. It's the foundational equation of monetary theory, which is called the quantity equation, also known as the equation of exchange. I like to call it the equation of exchange because that's just downright sexier. And that equation says that when you increase money supply, 2 things can happen. Either economic growth accelerates, which of course is the objective, and or price growth or inflation accelerates. But here's the thing, and you know this as well as anybody else, given the segments that you operate in, manufacturing, distribution, many of you, that during the pandemic, what was going on? Well, global supply chain disruptions, not enough workers, not enough truck drivers, not enough port handling capacity, repeat economic lockdowns, whether in China or elsewhere. And so as they were increasing money supply, output growth was constrained. So what took on much of the burden of equilibrating that equation? Prices. So the same people who've been telling you, hey, this is just transitory, are the same people who basically guaranteed it would not be. Now, of course, on top of this, we've had fiscal stimulus and other things taking place. But the Federal Reserve knew that the federal government was stimulating the economy for its own part. And yet they continue to operate in this fashion. They're still buying collateralized mortgage-backed securities when the housing prices were taking off. I mean, keeping interest rates as low as possible. Why? At that point, that part of the economy didn't need further stimulus in the housing market. Prices were getting higher and higher and higher. That affects affordability, and it's inflationary. But they kept doing that for much too long. And now in 2022, as I said, they had to pivot and now really aggressively tighten monetary policy presently because they didn't do it soon enough in 2021. In any case, I'm not suggesting to anyone here that the only reason we've had this bout of durable inflation is because of monetary policy or money supply. There have been, of course, supply chain disruptions. This comes from the Census Bureau's Small Business Pulse Survey. We'll be talking about the Citrin-Cooperman Pulse Survey in a moment, of course, but this is from the Census Bureau's Small Business Pulse Survey. You see the red line there? This is in response to the question, in the last week, did this business have any of the following or suffer any of the following? Domestic supplier delays. You don't see much improvement here. I mean, these data go back to August of 2020. We still have myriad supplier delays, domestic supplier delays in this case. The blue line is foreign supplier delays. Now, there's been some improvement perhaps since the worst of times in late 2021, but not anything profound. And worse than during the period of the pandemic, the worst period of the pandemic, which I suppose would be 2020 and early 2021, pre-vaccination. So really quite remarkable. This, of course, is inflationary, right? Because demand is high for goods, as you know, coming from the consumer, coming from businesses. People don't focus on this a whole lot, but business investment has been strong. Why is that? We'll talk about that in a moment. But again, these supply chain disruptions are there, and all of this is quite inflationary, especially in the face of elevated demand for goods. Now, the sheer nature of the economic expansion to date, the pace of it, has been cause of this inflation. This is U.S. gross domestic product graph back to 1990. The blue color bars are next to the left-hand axis, the red color bars to the right. You'll notice that the right-hand side vertical axis numbers are just much larger in magnitude to accommodate the volatility of the economy over the course of this pandemic. So if you read from left to right, the last blue colored bar here is the fourth quarter of 2019. It's the last quarter before we shut down the economy. It's a quarter of economic growth. We entered 2020 with momentum. We added jobs as a nation in January of 2020, added 376,000 jobs in February of 2020, shut down the economy in March of 2020. Now, March of 2020 is embodied, of course, by the first quarter of 2020, here designated by the first red colored bar indexed to the right. And during that quarter, that first quarter of 2020, the US economy shrinks 5% on an annualized basis. Well, ladies and gentlemen, that's big news by itself. So for instance, during the fourth quarter of 2008, which had been the worst quarter of our economic lives, the US economy shrinks 8.4% on an annualized basis. So a negative 5% print is a big deal. Unfortunately, this time around, it was merely the appetizer for during the second quarter of 2020, the US economy shrinks 31.4% on an annualized basis. That's that red bar that you see slumping to the south of the slide. And around this time, a furious debate breaks out in the economics community. What would the initial phase of recovery look like? Would it be U-shaped, L-shaped, Nike swoosh, check mark, square root, hockey stick? It was a straight up V. For in the third quarter of 2020, the US economy bounced back, growing 33.4% on an annualized basis. 33.4%. That's inflationary. Because this was a reflection largely of surging demand coming out of the early stages of the pandemic, but the supply chain issues remained very much in place. And maybe you will disagree with me with respect to this statement, but the supply side of the economy has been chasing demand ever since this recovery began, has not been able to keep up. Now, turning to the Citrin-Cooperman Manufacturing and Distribution Pulse Survey. So this survey conducted during the spring of 2022, here are some of the major findings and themes of your responses. So first, earnings rebounded in 2021. Of course, 2021 was a year of economic rebound. Actually, the rebound starts in, the latter half of 2020. Products performed better in 2021 than in 2020. More than 80% of companies indicated that EBITDA, earnings before various expenditures, was up from the prior year, compared to 47% of companies surveyed during the previous year. 75% of companies say their products performed at least somewhat better in 2021 compared to 2020. 25% say products perform much better. Yes, it's been a year of recovery. One of your frustrations perhaps is that for your particular product, whether you manufacture or distribute those products, there's probably unmet demand in many cases. So you'd love to be able to supply more if you could get more softwood lumber or computer chips or whatever it happens to be. We have seen, as you know, recently some improvement along the dimension of computer chip availability. Mercedes-Benz and BMW, for instance, have been indicated that they're now being able to acquire enough computer chips to operate basically at full capacity. And we have not seen that for quite some time. But nonetheless, supply chain disruptions and constraints persist. 65% of companies, again, this survey was conducted just very recently, a few weeks ago. 65% of companies say that global supply chain disruptions have caused a change in how their product is sourced. These disruptions have resulted in greater diversification of suppliers, outsourced manufacturing, and reshoring to the US. We'll talk more about reshoring as we go through these data. These findings are similar to last year's survey, but this reshoring situation is real. But again, we'll talk about some of the constraints to reshoring, but in recent weeks, for instance, we saw that announcement from Intel, maybe that was a couple of months ago now, indicated that they would invest $20 billion in the Columbus Ohio metropolitan area to construct several semiconductor manufacturing plants. I mean, those plants could go anywhere. They could go to Taiwan or Japan or China, or wherever they happen to, wherever they could go. But, Intel chooses the industrial Midwest, Columbus, Ohio. Now, the CEO of Intel, as it turns out, comes from Pennsylvania, Midwestern roots. But in any case, interesting, Ford Motor recently, as you probably have heard, announcing an investment of $3.7 billion in several Midwestern communities, Ohio, Michigan, and Kansas City, Missouri, is set to hire about 6,000 union workers in the process, largely to manufacture electric vehicles. Again, Ford is a multinational company. They could, manufacture outside the United States. They're picking the United States. So this reshoring story and the supply chain story in America is a real story. E-commerce holds steady. This is interesting to me. Online sales make up a similar share of total sales for retail and distribution as in the prior year's survey. A plurality of companies, 43%, indicate that online sales account for 51 to 75% of total sales. Now, remember that during the worst of the pandemic, online sales were climbing higher, and there was this notion that, well, once we get out of this pandemic, online sales will start to slump as a fraction of total sales as people go more brick and mortar. People have been going more brick and mortar, as it turns out, but in fact, based on the survey, online sales are actually holding pretty steady. And of course, stability is needed for growth, and we lack that. And we'll talk more about that in the context of the economic outlook later on in the presentation. Now, I'll be presenting for another 25 minutes or so. And so please, again, think about what questions you'd like to ask as I go through this material. Obviously, I hope to answer some of your questions as I go through the material, but so let's continue on with some information coming out of the Pulse survey. This again summarizes what I just said, but in quantified terms. So this relates to companies' EBITDA or earnings growth, earnings before interest, taxes, so on and so forth. In 2021, 47% said, we've seen some earnings growth. In 2022, 81%. And if you look at the red color bars here, the red color bars are the readings from the 2022 survey. The blue color bars here by category, the readings from the 2021 survey. And you can see 21% said significant growth in earnings, 60% some modest growth in earnings. Well, this is remarkable. But let's take a pause here. What we've talked about thus far, all these supply chain disruptions, rising cost of transportation and so on. So we'll talk more about these things as it turns out. And yet, earnings are growing. What does that suggest? You have pricing power, or at least someone who answered the survey has pricing power. Many people. Right, so that they are, yes, their costs are up, but they're able to pass along those costs to their ultimate consumer. Well, you might notice if you look at the sixth numeric column there, 1% of the folks with respect to their earnings say, I don't know. I don't know if my earnings went up or not. I don't know why that is. I don't know that that's a CFO issue necessarily. I think that's probably more, we're waiting to get paid. And, once we get paid for all the work we did in the previous period, we can tell you whether earnings grew or not, but, something like that. But very few reporting, you can see here, declines in earnings, right? Really quite remarkable. Some modest decline, 4%, significant decline, 2%. Quite remarkable how much pricing power has been enjoyed by manufacturers and distributors. And this is part of the inflationary story, of course. The fact that, yes, enterprises that have been experiencing cost increases have been able to pass those cost increases along. And so, everyone is facing inflation almost wherever, regardless, I suspect, of where they are in the supply chain. And of course, as I say, these supply chain struggles persist. Now, I shared with you some non-survey data regarding that, non-Citrin-Cooperman Pulse survey data. Let me share with you some data coming out of the Citrin-Cooperman Pulse survey. Let's look at the left side of the slide first. In which of the following ways have you changed your supply chain? More diversification of suppliers, 79%. Outsourced manufacturing, 49%. Reshoring to the US, 45%, ladies and gentlemen. This thing is real. No change, 6%. But almost all enterprises operating in manufacturing and distribution have been altering fundamentally how they operate. 65% of companies surveyed said that they have changed how a product is sourced due to global supply chain disruptions. 79% are diversifying suppliers, 49% are looking to outsource manufacturing, 45% are reshoring to the United States. So, I mean, and you can see 44% last year, 45% this year. Again, this reshoring episode is real. And one of the things, of course, that's happening is that enterprises are not just trying to, pass along cost increases, they're trying to deal with these cost increases to the extent that they can reduce their cost increase, that inures to the bottom line. A profit maximizer must be a cost minimizer. Well, it's tough, of course, to contain costs when we're in this kind of macroeconomic environment. So this is some producer price index data for commodities as of April of 2022. We're waiting for these data for May, but as I say, in May, we saw some of these commodity prices shoot up even higher. Now, look, I know this is a 93 octane crowd. I know this is a premium fuel crowd. And so many of you are probably filling up, your vehicles with more than $5 a gallon gasoline. So you might actually use diesel. And so my guess is that you feel in many cases that, well, if it's going to cost me more than $5 a gallon to fill up my tank, then I should have the road to myself. But you do not, as it turns out. The roads are still crowded, whether in Boston or Baltimore or wherever, where I am today in Tampa, Florida. And there is remarkably not much evidence that Americans are driving less because of these high gasoline prices. And that, of course, fuels, pun intended, this ongoing inflation. So fuels, related products, and power price up 74.5% compared to February of 2020. Now, I think you'd agree that power is pretty important to manufacturing because you're transforming inputs into outputs. Well, that's energy intensive, right? You're trying to change the atomic structure of an item, infusing it with energy to alter it into another form. Chemicals and allied products up 29%, obviously another major input into manufacturing. Rubber and plastic products up 28%. Lumber and wood products up 50%. Metals and metal products 56%. Iron and steel up 92.5%, though there's some indication, I think, that steel prices might moderate during the weeks ahead. Copper-based scrap 81%. I mean, this is what we're dealing with here. This is the producer price index for all manufacturing industries. It's another measure of inflation. I mean, if you look at things from the perspective of April of 2020, if you look at the red line here, who would have predicted this? Nobody, but of course we weren't predicting a pandemic either. As of April of 2020, as of April of 2022, the producer price index for all manufacturing industries was up 28% from February of 2020, 28% inflation in basically 2 years. So if you're a distributor out there, one of your headaches is that manufacturers applying to you at much higher prices. And all things being equal, that means that your upfront cost for acquiring inventory is higher, and then you've got to sort of try to pass along as much as you can those cost increases to your ultimate customer. That's a challenge, and it's capital and liquidity intensive, but that's where we are right now. The World Bank came out with a report just in the last 24 hours indicating that this inflation will persist globally. The global economy might be facing stagflation. They're downgrading their forecast for global economic growth. So that's where we are right now. And if the economy slows, one of the questions that distributors and manufacturers might have to ask is, can we continue to pass along these cost increases as we have? Again, the recovery economically has been brisk, and that's provided some space for people to be able to pass along some of these cost increases. And of course, I want to point out that shipping costs are also elevated. This is from the Baltic Dry Index, one of my favorite leading indicators for the global economy. In fact, I've been so enamored with the Baltic Dry Index, this indicator, for decades, as it turns out. In fact, back when I was single, I was so enamored by this leading indicator of the global economy that I would often introduce the Baltic Dry Index into my conversation with young women in an attempt to garner interest. And it might surprise you to learn that very little interest was garnered. I spent a lot of time by myself during the 80s and 90s and eventually gave up and got married. But the point is, what is the Baltic Dry Index? The Baltic Dry Index is a measure of the price of shipping major raw materials like metals, fossil fuels, and agricultural products by ship. These prices remain elevated. They've come down from the peak. You can see that, but they still remain elevated. It's a leading indicator for global economic growth, parenthetically, because if transporters are transporting a lot of raw materials around the world across the seas, then that means that demand for raw materials is high, which ultimately translates into lots of output. But that said, you can see that those shipping costs remain high. They have come down a bit. And so that might actually indicate some level of stagflation, right? A bit softer economic growth, though we still have these inflationary pressures very much in place. So getting back to the Pulse survey, cost management, a major issue, of course, for all. Well, that's true even for an economist who runs his own firm. I also engage in cost management. I'll give you an example. I right now lease 2,400 square feet of office space in downtown Baltimore. My next lease, 481 square feet. So we all, engage in this kind of activity. But according to the survey, half of companies are seeking to manage cost of product by manufacturing more products themselves, 57%, renegotiating forward contracts for purchases, 53%, and renegotiating freight contracts, 49%. So my guess is lawyers are very busy trying to renegotiate or help renegotiate these things and codify these new arrangements. Third-party warehousing and logistics providers have been a major part of the solution. 65% of companies responding using third-party warehousing or logistics companies, 65.5% of companies responding use third-party warehousing or logistics companies to help them manage their products internally. That's up from 58% in the 2021 survey. But associated costs are rising. Only 8% of companies did not experience any growth in the cost of storing inventory. 75% of companies saw at least 10% increase in those costs. All right, so if you look at the tabular data toward the southwest corner of the slide, we're manufacturing more products by ourselves, 57%. At that vertical integration, renegotiating forward contracts, 52.5%, so on and so forth. How many say none of these? 2%. Everyone is scrambling to try to contain costs and, of course, to price correctly. And again, because the economic recovery has been pretty strong, again, this comes from the Pulse survey, most companies are managing to pass costs to their customers on a regular basis. So the question here is, how often are you passing production and added supply chain costs to your customers through raising your prices? Monthly, 20%, 1 in 5 saying, I'm gonna raise your prices monthly. And in many cases, customers are saying, I can't, there's nothing I can do about it. If that's what you're gonna do, that's what you're gonna do. Right, again, EBITDA is rising for most survey participants. So that means that they're successfully passing along these cost increases. Quarterly, 54%, right? So between monthly and quarterly price increases, we're talking about 3/4 of survey respondents saying, we're passing along cost increases. And again, that gives you some sense of how dramatic these inflationary pressures are. Because as it turns out, you don't necessarily want to pass along cost increases to your customers in the following sense. You like your customers. You want your customers to stay loyal to you. You want to deliver them as high quality service as possible. And some of that relates to the pricing, of course. But what can you do? If your costs are going up and you're trying to at least hold earnings stable or steady, then you've got to pass along cost increases, and maybe quite often, as this suggests. So now, again, one of the ways in which to minimize delivery costs and supply chain disruptions has been reshoring. We've been seeing lots of reshoring to this country since 2010, by the way. So the Great Recession rearranged many of the deck chairs and started people rethinking how they supply their customers and from where do they supply their customers. But the pandemic, of course, serves as further catalyst to reshoring. So, but there are hurdles to reshoring. Now, the blue-colored bars here, again, relate to the 2021 survey. The red-colored bars relate to the 2022 survey. So what are the major hurdles to reshoring? Well, back in 2021, the leading answer was capital investment costs, right? If I've got to reshore, I've got maybe capacity back in China, or I've got capacity someplace else in Asia or South America, wherever it happens to be, Latin America. And so all of a sudden I have to recreate that capacity, that productive capacity or distribution capacity here in America. But that has been supplanted as the leading hurdle to reshoring by what? The cost of US labor. And this is the real challenge for the Americans, I think. We're good at amassing capital. We're a capitalist society. We're the best people in the world at amassing capital. Are we the best people in the world to train an industrial workforce for the 21st century? I'm not quite so sure. We don't have enough skilled craftspeople. We don't have enough welders and millwrights and machinists and mechanics, not to mention truck drivers. That's a real hurdle here, because that scramble for skilled craftspeople that technical talent that works in manufacturing, construction, related fields, that's where much of the shortage is. And in China, of course, they have a massive industrial workforce. Growing industrial workforces in Bangladesh and India and Malaysia, Indonesia, so on and so forth. Then we Americans have to be able to match that, in some sense. We have to provide more workers. Yes, I know we're becoming more capital intensive. There's more automation, more robotics, more 3D printing, more artificial intelligence, more driverless vehicles, all that. Nonetheless, you still have to have human capital to operate that technology. So this has been a real challenge, of course, in terms of cost minimization, as workers are becoming more expensive and often lack the skills necessary to allow us to implement new technology. In fact, let's talk about the labor market, shall we? And how tight it is. So again, this is inflationary. This gets back to that inflation story. One of the things we get from the government every month are data from the so-called JOLTS survey, the Job Openings and Labor Turnover Survey. The latest reading is for April of 2022. And that survey indicates that as of April of 2022, America home to 11.4 million available unfilled jobs. We have 1.9 job openings for every unemployed American. This is still the land of opportunity, especially for the Celtics, right? Jason Tatum, I hope will bounce back tonight. But in any case, this is still the land of opportunity, right? If you want to work, there's a job waiting for you. In fact, there's 2 of them. Actually, there's 11.4 million of them waiting for you. That's inflationary, of course. And one of the reasons that manufacturers, distributors, and others are scrambling for talent is that the size of the labor force has shrunk over the course of the pandemic. It's been recovering recently, the size of the labor force, but the labor force in America, meaning the people who are working or looking for work, who are actually actively engaged in the labor market, is down about a couple 100,000 from pre-pandemic levels. But remember, demand is high for goods and services. So we're having to do more with fewer people. And by the second quarter of 2021, gross domestic product was above what it was pre-pandemic. We're down in the second quarter of 2022, of course, but a year ago, GDP had bounced back above its pandemic level. So, we're doing more with fewer people. In fact, I can, put this in percentage terms. This is the US labor force participation rate graph back to 1950. Now, as an aside, you can see here how rapid labor force growth was, or participation growth was, during the late 60s, 70s, and through the 80s. And this is because women are entering the labor market en masse. You might remember a show from the 1980s called 30-something. So, we had moved during the previous decades from single income households to 2 income households or dual income households. The 30-something was about, the struggles of those couples with, both members of the both husband and wife, as it turns out, working and therefore struggling to pick up dry cleaning on a timely basis. It was not a very deep show, by the way. It's just very good looking people. That was pretty much the premise. But the point is this pattern of rising labor force participation ends with the turn of the millennium. At pandemic eve, the labor force participation rate is in the range of 63.3 or 63.4%. It then plummets to 60.2% as 8 million people leave the labor force for various reasons, including fear of infection. It's since bounced back to 62.3%, but it's lower than it had been. And so that struggle for talent has, there's many reasons for that, skills mismatches, so on and so forth. But one of them is just the sheer reason that the labor force participation rate continues to be so low, including, by the way, among young American men. I mean, what are young American men doing? My guess is mostly weed. But, if you look at the labor force participation rate among young American men compared to historic norms, I mean, often it is said, by the way, that women make less than men, which is true, by the way. Women make less than men. But young women do not make less than young men. And that's a reflection, of course, that young women have great opportunities or greater opportunities than they might have had in the past, but also that the young men are falling behind in this country. So, I don't know what to tell you. I don't know why I'm saying all of this, but if we're looking for ways to tap our potential that are untapped, young people, including young American men, are one of the places I would look first. So no surprise here with this scramble for talent. That's inflationary. I mean, how do employers respond to this dearth of available workforce? They jack up wages. This is the employment cost index for private sector workers. That dark blue line there represents wage and salary growth, 12-month percentage change. The lighter blue line there at the bottom represents benefit cost increases. So at first, to match, for instance, Amazon, for instance, $50 an hour, $70 an hour for entry-level workers, employers, often try to match that, right? That's some kind of a baseline, at least in certain communities. More recently, it's been benefit cost increases, right? To try to tailor the benefits package to try to recruit and retain workers. Obviously, we're in the midst of this great resignation. A couple of months ago, 4.5 million Americans quit their jobs in a single month. 3% of workers quit their jobs in a single month. So that's been part of the inflationary story as well. By the way, this is misleading to a certain extent. Again, for instance, that light blue line there at the bottom, that's benefit cost increases. So we employers can offer our employees benefits that are not monetized, they're not quantifiable. I'll give you an example. So I have 12 employees, including myself, downtown Baltimore. I have, as I say, about 2,400 square feet of office space leased. All my workers are working remotely right now. All of us are working remotely right now. I had asked, and most of my workers, by the way, are millennial economists, mostly in their 30s, millennial economists and analysts. And I had asked them to come back to the office on Tuesdays and Thursdays because I'm paying rent. I just want to justify having a lease, I'm paying the rent. And they said to me, boss, and they actually called me that, boss. Boss, it's a great offer, but it's not going to happen. Now, as it turns out, they didn't actually say it in so many words. They actually just didn't show up. But the point is, I'm offering the opportunity for them to work remotely. That's a benefit to them. But you won't see that on this slide because there's no transaction there. It's not monetized. So again, some of the things that we've been offering our employees wouldn't be reflected on a slide like this. And if you take that into account, the compensation growth, which is in the red line, that sandwich line, is even greater than this might reflect. So technology, of course, is one way to deal with this. I pointed out earlier that businesses are spending a lot on equipment, or at least trying to, if they can find the equipment to purchase. And that's because they're trying to identify force multipliers. If they can't find enough workers, they're trying to ensure that they can make those workers that they have on staff more productive. And so technology is a big part of this. This, again, comes out of the Citrin Cooperman Manufacturing Distribution Pulse Survey. So companies are doing a lot of things. They're using data analytics to improve efficiency of product sourcing, better predict timing of demand, better understand consumer behaviors, predict geography of demand, right? To get this right, that's part of cost minimization. Use the data. If you don't have the people, use the data as a force multiplier. 85% of companies are using AI. So if you're not using artificial intelligence, please understand that many people are. I'm not using artificial intelligence. I'm probably not using any intelligence at all, as it turns out. You might say that. But the point is, 85% of companies are using AI, particularly for robotic tasks and to gather and analyze data from outside the company. About half of companies are having their cybersecurity activity monitored and or have performed a cybersecurity audit in the previous 12 months. Half of companies. So if you're part of the half who has not done that, that's something to think about. That's what the survey suggests, at least. Most companies are actively working to improve their use of data. Almost 72% are currently implementing tools and processes to improve the use of data analytics. It's about data. It's about scientific analysis. It's what the economist Joseph Schumpeter predicted would happen. One of the great economists in the history of humanity, Joseph Schumpeter, predicted that we would become better and better at capitalism through the use of data. And this is, he was writing well before the operability of computers. But technology still needs people, right? So if you're trying to embrace new technologies, that means not just new equipment purchases, for instance, new processes, but it means training one's workforce to deal with that. Again, this comes out of the Pulse survey. Technology still needs people. Companies cite, quote, building the digital skills and capabilities of employees as the top factor important for successful implementation of those tool/processes. But again, if you're trying to train workers and they keep leaving for other jobs because there's not much loyalty out there right now, the great resignation, then it becomes sort of a treadmill, right? Keep training, trying to implement these new processes and technologies. And then people leave with the knowledge of how to do that. And now you've got to train someone else. I'm not saying that's happened to everyone here. I'm saying that is a scenario that is conceivable. So, let's talk about the tabular data the graphical data at the bottom of the slide here. Think about implementing those tools and processes. Please rank your top 3 most important factors for successful implementation. Building the digital skills and capabilities of our employees. Number 1 factor, and so we need workforce. Again, it gets to that. So now, let me go for another 5 or 7 minutes here. Let me give you the economic outlook. Again, I hope this has been a productive use of your time thus far, and I really look forward to Q&A. So please, do ask those questions because it tells me that at least during the Q&A section, if not prior to that, being relevant to you. So companies face challenges still in this environment. Again, this comes out of the Pulse survey. So from the following list, what is your company's biggest challenge today? You can select your top 3 choices. Changing the business model to adapt to crises like COVID-19, 48%. Many of you are telling us, or at least telling the Citrin Cooperman surveyors, we're trying to be resilient. We're planning for the next crisis. What's it going to be? I mean, we've had pandemic, we have war in Eastern Europe, what's next? Something will be next, as it turns out. That's the way the world is. The world is fraught with hazard. And companies are already thinking about, how do we deal with that? Whatever the nature of the crisis turns out to be, how do we make sure that we're resilient? Now, it says 48%, have selected that as one of their top 3 choices. That means that more than half didn't. So, some people are not thinking about this, but perhaps everyone should be. Ability for a workforce to embrace and utilize changing technologies, 39%. Well, we just talked about that, right? It's about workforce, this fighting workforce. If we Americans can get this right, to graduate kids from high school who know some math, right? Algebra 1, algebra 2, some geometry, maybe. That's a triangle, 180 degrees, got it. We can go a long way. This could be our century very easily. Ability to finance growth, 31%. And that's interesting because now, of course, the cost of capital is rising. The Federal Reserve is ratcheting up interest rates. They've become quite hawkish in their language. So it may be that in future surveys, the ability to finance growth will become even more of a concern going forward. Now, there's other issues here, managing cash flow, supply chain, so on and so forth. Which of the following, if any, do you anticipate occurring for your business over the next 3 years? So businesses are facing challenges, but they still expect to expand. 32% said significant increase in the workforce. You're still looking to expand, which I view as very good news, by the way, right? That we have all these challenges in the economic environment, and yet many of you are still positioned to grow. You want to grow. You have that ambition. Capital investment involving improvements, buildings, and equipment exceeding $500,000. So, lumpy capital expenditures are part of the story too. And again, to finance these expenditures will become more expensive going forward. One would predict, based on what the Federal Reserve is suggesting and what it's actually doing. A potential expansion of the business into a new facility or plant, 20.5%, right? That's part of expansion, I suppose, or shifting technology. Maybe that warehouse doesn't work for you anymore. Maybe the ceilings are too low, whatever it happens to be. Reduction of office space, 11%. And I didn't answer the survey, by the way. I'm just analyzing data here, but I'm part of that 11%. I'll be reducing my office space. Companies want stability, of course. From the following list, which are the biggest keys to your future growth strategy? Number 1 factor, stabilization of supply chain. Number 2, stable workforce. Number 3, utilizing best-in-class technology. 4, e-commerce, so on and so forth. 5, new products. Stabilization of supply chain is number 1. But this world is fraught. So how do you create this, a resilient supply chain? And again, we pointed out earlier in the presentation, part of this is diversifying suppliers, right? If supplier A can't get it done, then, it's nice to have supplier B or C available to you. Which of the following do you believe is needed now or in the near future to keep your company competitive? 62% said the ability to gather and analyze customer data to better predict their behavior. 62%, nearly 2/3. I find that remarkable. It's about data analysis. The ability to gather and analyze data from suppliers' ERP systems to better predict supply chain delays and cost changes, 61%. Same answer, data. So, again, I think the survey provides some really strong insights into how businesses are coping with the situation. Now, some leading indicators for the broader economy, macroeconomy. This is US manufacturers' new orders for consumer goods. I don't see any sign of the consumer slowing down right now. I think the consumer will ultimately. Wait till they get their air conditioning bills, as we go through the summer. Then they're being hit by higher food prices, fuel prices, rent, so on and so forth. Now, thus far, the consumer has responded by saying, I don't care. Airfares are up, I'm still flying. Gas prices are up, I'm still driving. But at some point, those accumulated savings are going to be dissipated. And I would say that one of the things you will see over the course of this year is that steadily the consumer will weaken. This is from the Philadelphia Federal Reserve's Manufacturing Business Outlook Survey. Talked a lot during this presentation about supply chain issues. This question pertains to future delivery times. And yes, we have Russia, Ukraine. Yes, we've had recent lockdowns in China, though as I understand, the port of Shanghai is now starting to operate toward full capacity. But based on at least manufacturers in the Philadelphia Federal Reserve District, they think that delivery times are going to fall. And I don't know if you're experiencing this or not, but you take strong consumer demand and you marry that to what seems to be the supply side of the economy that's improving in fits and starts. I mentioned computer chips earlier. The next few months should be quite good for the US economy. In fact, if you look at the Conference Board's index of leading economic indicators, it continues to signal growth. So you'll hear many economists who are quite sanguine about the US economic outlook, who think that the Federal Reserve can engineer the soft landing, slow the economy by raising interest rates and shrinking their balance sheet, wring inflation out of the economy without driving us into recession. So my final slide, if you're an economist, you have an outlook, I forecast. I typically forecast twice during the year, by the way. I forecast at the beginning of the year, which is the forecast I'm providing for you now, and then I forecast at the end of the year, and my forecast becomes whatever actually transpired. And in that way, my forecast always proves to be correct. So I spotless record, Citron Cooperman invites me back. But look, this will be a year of growth, but 2023 could be very different. And what's the issue here? Federal Reserve, right? Trying to engineer the soft landing, largely by raising interest rates. Now, since the early 1980s, we've had 8 previous rate tightening cycles. 6 have ended in recession, 6. The Baltimore Orioles have a better record with Chris Davis at first base. So I think this time around, because inflation is so elevated relative to what it has been during previous cycles, it's going to be even more difficult for them to engineer that soft landing. I don't think they get it done. I think we head into recession next year. On top of that, the economy will remain unbalanced with supply struggling to keep up with demand. Yes, I understand supply, at least according to some indicators, has been improving. Delivery charges have been falling according to some indicators, but you got Ukraine, Russia, you still got this virus floating around. And so, we're still in this world that is fraught. Inflation may have peaked, but will remain elevated. We talked about that. Stagflation, anyone? The combination of stagnation and inflation? Oh, I bet you, absolutely. That was what the first quarter of the year was about. During the first quarter of the year, the US economy actually shrank 1.5% on an annualized basis. Inflation was high. That's stagnation and inflation. And I think you'll see some of this story play out, not necessarily in the next few months, because I don't think we'll have stagnation. I think the summer months will be pretty good for the economy. The consumers out there, they're traveling and so on and so on. They're shopping still, they're buying. Housing market's slowing, of course, but other segments of the economy are not. But stagflation, I think, is a concern for those in manufacturing and distribution. Why? Because it gets at the question of how easy it will be for you to pass along your ongoing cost increases to your customers. Thus far, based on the Citron Cooperman Pulse survey, you've been able to pass along many of your cost increases. But can that continue as the economy is softening in 2023 or toward 2023 as we head toward that year? I'm not quite so sure. Maybe you are, but that's an issue. And yes, I'm an economist, so I'm forecasting interest rates to increase. You ask economists almost anywhere, dry cleaner, movie theater, ballpark, arena, are interest rates going to rise? We'll say yes. Well, we do that for 40 years. And most of the time we've been wrong, by the way. Interest rates have generally fallen for the past 40 years. It doesn't stop us from saying such things because no one holds us accountable, and I don't want you to start. And with that, let's go to Q&A. I will stop sharing, and let's turn it over to those questions, shall we? We have a few more minutes left.
That was fantastic, Dr. Basu. Thank you very much. You just hit a nerve because we got a flurry of questions that's come in the last few minutes. So I'm going to combine a couple because I think they're all, a few of them are about where your predictions are going. So one of them, what are the indicators that would show the economy starting to slow? What are kind of your leading indicators? And to dovetail on that, another question, similar topic was, is it stock market related, interest rate related, or real estate related? Are those some of the key leading indicators?
Well, certainly the stock market is often viewed as a leading indicator for the economy. And the volatility of the stock market will be down this morning as it turns out, but it was up the last couple of days. But that volatility, I think, is an indication that not all is right. I think the markets will be down even more aggressively, but for a couple of factors. One, corporate earnings have held up reasonably well. But the second factor is where else are you going to put your money, right? Where else are you going to put your money other than US equities? And there's still lots of liquidity out there. But the fact that the market has fallen, so if you think about the stock market's value is earnings, aggregate corporate earnings divided by the interest rate. So we've seen interest rates go up, which if you think about it, that would tend to compress the value of the stock market. That's exactly what we've seen. But now the question becomes corporate earnings. And as I say, if we're heading into a stagflationary macroeconomic environment, I think you'll see some resistance to earnings growth. So we saw that at Walmart and Target, for instance, very recently, not so much at Macy's, of course, and some retailers that actually did quite well during the most recent quarter. But I think we're starting to see that, at least for those retailers that serve the lower quintiles of income, that they're starting to see more resistance, right? Target is having to liquidate a lot of inventory right now because it wasn't purchased. So, and that hurts their corporate earnings. So in any case, I'm looking at that as a leading indicator, but I'll tell you, the number one thing I'm really looking at is typically not thought of as a leading indicator is retail sales. If I start to see the consumer backing off because of these inflation pressures and because their savings have been diminished, right? They're no longer releasing that pent-up demand to the market. That's what's going to tell me I'm right about 2023.
And that ties into another question, which references one of the slides you showed on the survey, was that companies are passing costs along to their customers. Do you see that they're also capturing profit or margin when they're passing those costs along?
Yes, I think that that's right. They in fact are in many cases. So, we've got this kind of price volatility and this lack of transparency in pricing, right? Because no one knows, and people have become accustomed to lumpy increases in price, right? Whether it's for softwood lumber or for steel or whatever it happens to be, that you can probably build some margin in, right? I'm quite sure that there are lots of gasoline station operators right now who are building in some extra margin because gasoline prices are high. There's not much transparency in pricing right now, and they're taking a few more cents per gallon. That's my guess. I'm not saying they're gouging. I'm not making that accusation, but they are trying. They're raising their earnings that way. And so, yeah, it wouldn't surprise me. And again, earnings by and large in America have held up pretty well, including for manufacturers in many cases, right? So that suggests that they are in fact passing along those cost increases and then some.
All right, here's another one. There's been an influx of cash due to PPP loans, employee retention credits, all the government stimulus money that's been out there. What do you think, based on your predictions for 2023, what do you think the most valuable or effective way for companies should be to employ that cash? Should they reinvest? Should they hold the cash? Any tips or strategies there?
That's a tough one because every business is different, right? And therefore, every company has a different opportunity set. I'll tell you something right now, and I'm a small business owner myself. I'm an economist, but I'm a small business owner, so I'm thinking about accounts receivable and accounts payable. It gets down to that. I love the notion of holding cash. Now, look, I'm not in manufacturing, so I'm not thinking about the next technology, right? Next year, I'm going to do things that I've been doing the same way, basically, right, with a computer. So if you're in a business which is just moving towards technology and your competitors are sort of, moving up the technology ladder and you have to move with them, that's a different story. I get that. But given the uncertainties of the economy, having some extra cash, more cash than usual, I think is quite prudent if it's possible.
And one last question, looks like we're coming up on 10. How do you see, one thing that the companies are always looking at is warehouse space. I think one of your slides mentioned 3PL usage is up in terms of third-party logistic companies. How do you see interest rates impacting commercial real estate valuations?
Look, I think commercial real estate valuations are really fraught with hazard. And part of this is because of economic fundamentals. It's not just because of rising interest rates. When interest rates rise, capitalization rates tend to rise, as it turns out. And that squeezes the value of commercial real estate. But if you look at the US office vacancy rate, it's rising. This remote work is real. I mean, I speak every once in a while to a commercial real estate broker says, Anirban, because that's my name, Anirban. Anirban, this remote work thing, it's exaggerated in terms of its effect. Oh, I don't think so. It's real. Okay. Second thing, hotel occupancy is down still. I mean, it came back a little bit in 2021, but well below its pre-pandemic level. And then mall vacancy in this country is sky high, and many malls will falter over the next 5 years. They're going to be adaptively reused for something else. It could be data centers, fulfillment centers, affordable housing generally, outpatient medical clinics. But the point is, lots of adaptive reuse, by the way. So we'll see a lot of properties reused for something else. That's where the money's to be made in real estate, as far as I'm concerned. But in terms of commercial real estate valuations, I think that'll be one of the worst performers in the economy right now, just because of all these economic fundamentals. Industrial space is a bit different. That's strong, but Amazon just said, what? We have enough space, thank you very much. And so even the industrial market now is going to be weaker than it has been.
Well, thank you. This has been extremely entertaining for one and informative. I hope everyone got a lot of value out of it. We had a lot of questions. One thing for everyone to note is our survey is dropping today. So if you're looking for a copy, we'll send out links and you'll have access to that. But Dr. Basu, thank you so much for all your help and guidance here.
Thank you very much, Citron Cooperman, for making this possible. Thanks to all the stakeholders that were on today. Really a privilege.
Thank you. Goodbye, everyone.